So I'm going to take you through our results with a bit of an overview to start with before handing over to Tony to go through the financials, and then I'll come back with a bit more detail on the businesses and an outlook. So I think an important thing to really note is that during the last 18 months, following the acquisition of Networkers, we've completely repositioned the group. Prior to this, we were a UK-centric, single-site, generalist recruiter, dominated by our engineering division, but also operating in IT. And we were attempting to grow our finance, sales, HR and procurement businesses through the expansion of our Barclay Mead brand. We're now a highly specialised engineering and technology recruitment business with a nicely differentiated position. There's no other recruitment firm of our size and our geographical spread which is focused purely on these disciplines, and no one better placed to benefit from the convergence of engineering and technology. There's plenty to go for in these markets. We're the UK's #1 engineering recruiter, and yet we estimate our market share at less than 5%. The global engineering recruitment market is valued at $26 billion US, and the IT market's even bigger at $57 billion. So we've got the capacity for substantial growth by sticking to our knitting as specialists and continuing to develop our narrow and deep sales strategy. Following the acquisition of Networkers last year, we now operate in 11 countries with around 750 employees, and as you can see from the map, we cover most of the English-speaking recruitment markets with the exception of Australia, but we also have a presence in China. Since acquiring these overseas offices, we've appointed regional managing directors for Asia and the Americas, and we've seen very good growth coming from these regions. You'll notice the lack of presence in most European countries. These are tougher markets for UK recruiters. However, we're beginning to lay the groundwork for planned expansion there as we follow our clients. We've recently won a pan-European managed service program to supply 200 to 250 contractors to Unisys. And in order to service this, we've established operations and an account management team in the Netherlands and Spain, as well as in Germany. And in addition, we've established business infrastructure and obtained licenses which allow us to deliver directly into the 9 countries in the scope of this contract, making it easier for us to provide services to other clients. So that's definitely something that we intend to build on in the future. And as you can see, we have around 9,000 contractors out, 7,000 of which are in the UK, highlighting the opportunity overseas, and as well as being the biggest UK engineering recruiter with the 5th largest in technology. As you know, we changed our name, PLC name, to Gattaca in August, and at the same time we completely reshaped our trading brand architecture. What we did was based upon the research we carried out a couple of years ago into what customers and clients value in a recruitment service. Top of the list for both groups was the desire to deal with the true specialists in their field, people who could represent the brand in the market professionally and who could give career advice and market insights as well as complete the next transaction. This finding deeply influenced our branding decisions. After the Networkers deal, we decided to consolidate the numerous engineering and technology businesses we had under 2 core brands, Matchtech and Networkers, reflecting 2 distinct specialisms. Barclay Mead and Alderwood continue to operate as complementary brands, but now supporting our engineering and technology clients' professional staffing needs. We also took the opportunity to remove some of the confusion externally and sensitivities internally that a common group and trading brand, Matchtech, had given us. We chose the name Gattaca based upon the culture of the business, which for me is a huge driver of our success. With our founding shareholders still in place and on the board, the group still has a family business feel despite its size, and the Gattaca brand expresses the idea of a group of people, each unique, with their own specialisms, but at the same time being part of a bigger entity with shared DNA and a common purpose. And one important side benefit of the Gattaca brand is that we can use it on the occasions when our clients want us to provide a total recruitment solution spanning engineering, technology and managing a supply chain of other recruitment services. So this is the shape of the business today. Pre-acquisition, we were highly UK-centric with only 2% of our NFI coming from overseas. Now in the top row you can see that overseas business represents over 30% of our NFI, and over the next 3 to 5 years I'd be surprised if we don't see that international dimension approaching close to half the business. Why is that important to us? Because growth rates and gross margins are higher outside the UK, competition is less intense, and we want to diversify our earnings away from a dependence on the UK economy. As you can see in the second row down, we're still predominantly an engineering recruitment company, though technology is now at 40% of NFI. We expect both businesses to develop to equal size as we sell more solutions type packages to a wider range of clients, as the number of requirements for IT skills is higher than in engineering. And on the third row you can see that around 3/4 of our business is done through a contractual relationship with our clients. That's important because it makes us relatively sticky as a supplier. Our engineering contractors' average assignment length is 12 months, much longer than average contingency or spot booking. And on row 4 you can see the split between our contract and perm placement business. That's good because the contract revenue is recurring and predictable, while perm is pure margin with no cost of sale. So very good in a buoyant market, less so when the economy is slowing. So we like to be able to flex that ratio in line with the economic cycle. I'll now hand over to Tony to take you through the highlights and our results.
Okay, thank you, Brian. So on to the highlights. Profits were in line with market expectations. Engineering continued to perform well, up 6% with strong growth in infrastructure, aerospace, energy and general engineering, netted off by weaker performance in automotive and maritime. And the engineering technology business, which is an amalgamation of two existing teams who bridge the gap between engineering and technology skill sets, is already one of our fastest growing businesses. As we previously advised, technology did not perform as well, with NFI down 6%, whilst the telecoms business delivered good growth. The IT business suffered from a lack of adequate focus on clear end niche markets. Changes made at the half year to increase specialisation has led to improving results in the second half of the year. Integration cost synergies of 3.1 million will be realised in 2017, much of which has been reinvested in strengthening the business. And the total dividend for the year has been increased by 5% to 23 pence per share. Turning to the income statement, the statutory results show the full year effect of the Networkers acquisition on the group, with revenue up 23%, net fee income up 33% and profit before tax up 34%. Here you see the impact of the Networkers' high margins, with contract gross margins up from 8.2% to 9%, and overall gross margin up from 10.9% to 11.8%. Next to the statutory results, we have shown the pro forma underlying results, and what this means is for 2015 we've included trading of the Networkers business pre-acquisition, and we have stripped out the trading of divested businesses, amortisation and non-recurring integration costs, and exchange gains on balance sheet revaluations due to the sterling devaluation. So on an underlying basis, overall performance was broadly flat year on year in terms of revenue, net fee income and operating profit. NFI conversion to operating profit was up from 29% to 30%, and profit before tax was up 4%. One of the impacts of the Networkers acquisition is on our effective tax rate. Networkers tax rate was generally higher, in the high 30%, as on average overseas corporate tax rates are higher than the UK, and in addition we suffer from withholding tax on overseas business. We do price withholding tax into our contracts on the gross profit line, and we are able to recover some of this tax in the UK, but we're looking at ways of seeing if we can increase the amount we can recover. But broadly, the tax rate will be in the mid-30s going forwards. On to earnings per share for the year. Basic earnings per share of 32.1 pence was up 4%, and diluted earnings per share of 31 pence was up 5%. Adding back the amortisation and non-recurring costs, the underlying earnings per share for 2016 was 45.9 pence per share. And strong profitability and cash flow gives us confidence to increase the dividend by 5%, as I said earlier, and that dividend has a cover of 2.1 times, which is quite comfortable, and we've always stated our policy is to have a cover of 2 over the cycle. Moving on to the cash flow, strong cash generation of the combined businesses, 15.5 million of cash generated pre-dividends, and net debt was reduced by 8.6 million from 33.6 million last year to 25 million at the 31st of July this year, including, as you can see, a total dividend payment of nearly 7 million. And if we look at the historical cash generation and net debt over the last 10 years, excuse me, you can see we have a history of strong cash generation pre-dividends, reducing net debt year on year, with the obvious exceptions of the recessionary period 2009 to 2011 and the funding of the Networkers acquisition last year. Debtor days have increased marginally to 50 days from 49 last year. I think we can do a little bit more on that over the next 12 months, but broadly it's going to be around the high 40s going forwards. And then in terms of the integration of Networkers into the group, large parts of the integration are now complete. There's still some harmonisation of back office systems, in particular rolling out a global finance system, but we expect to have closed off the integration by the half year, with some final costs coming through in H1, netted off by some additional synergies. We last reported annualised synergies identified of 2.3 million. We've now exceeded our target, and this now stands at 3.1 million. But as I said before, much of this has been reinvested in strengthening the business, 1.8 million annualised, and that investment has gone into regional MDs for the Americas and Asia, strengthening functional management and strengthening our business development capability. We're also moving into a new London office, which gives us 3 times the capacity of the existing offices, but 36% cheaper per square foot than it would have been to extend the existing offices. So I'll pass you back to Brian. I'll go through the operational highlights.
Thanks, Tony. So looking at headcount, first of all, we ended the year with a direct headcount of 753. And as you can see, reading across from left to right, the proportion of our NFI coming from each region is broadly in line with headcount, albeit we've got some investment in the international business in order to generate sales growth here. As you heard from Tony, during the integration we were able to remove duplicate line management and group support heads, which realised significant cost savings. That said, we have invested back into the business to strengthen management regionally and in some cases functionally. There are some more finance heads to come out of the Networkers head office during half one as we bring the finance systems together in Whiteley, our registered office, and that therefore could reduce management and support headcount in the UK by up to 10 people. And over the course of the year we'd like to get the ratio of sales to non-sales headcount down to nearer 75-25 as we improve back office efficiency and grow our sales forces around the world. However, we are constantly reviewing headcount and we won't hesitate to make adjustments where necessary. As before, the UK remains our engineering stronghold. You can see that represented there on the left-hand side in blue, with technology, the purple part of the pie chart, the biggest part of the business in the rest of the world. Looking now in a bit more detail at our engineering business, you can see that we had solid growth in NFI of 6% over the year, with the exit rate in Q4 of 4%, including 1 month of negative growth post-Brexit. Perm has been growing faster than contract at 8% and 5% respectively, though there are signs that this is now reversing as confidence weakens. However, we did achieve the strategic objective we set ourselves 2 years ago of improving our engineering contract per mix to 70-30. Bottom right, you can see how undeveloped engineering currently is outside of the UK. This is a huge opportunity for us, which we're going to be investing in the coming years. Bottom left, you can see how the engineering NFI splits down by sector, and I'll go into a bit more detail on the specialist markets on the next slide. However, general engineering saw good growth of 10%, and our professional staffing business, which supports engineering and technology, also had a strong year, with NFI up 16%. Moving now to the biggest of our engineering divisions, which is infrastructure. Very strong year here. It now represents 28% of the division and was our fastest growing business last year with 18% NFI growth. Water, rail and private highways, transportation and planning remain strong, although we are seeing some weakness in buildings with low confidence in the private design sector. That said, with recent government approvals of some long-standing infrastructure projects which have been blowing in the wind for a while, so Heathrow and Hinckley, we're very confident about the medium and long-term prospects for this business. Our energy business was down 7% year on year, albeit quarter four was flat with quarter four last year, so we think the negative impact of the low oil price is bottoming out now. Obviously oil and gas was significantly down, offset to some extent by nuclear, renewables and transmission contracts. Maritime had a challenging year, down 9% with the lull in naval build programmes. However, with the engine refurbishment programmes and the approval of the successor submarine project going ahead, we now expect a return to growth. And I'm pleased to say that aerospace is performing strongly also, with 11% growth on the back of strong order books for existing aircraft production. And automotive had a poorer year, dropping by 4%, although this masks a great success in a contract win, which we expect to see that recover during the course of the rest of this year. And Tony's already mentioned engineering technology, our newest business unit, which is performing very well, 17% growth in contract NFI, a real sweet spot for us, as our clients tell us that no one else can fulfill requirements across engineering and technology as a single provider in the way that we can. Moving on to technology, that was down 6%, and as we reported at the half year, within technology, telco had good growth of 9%, but it was offset by problems in our IT division, which had a 17% decline. However, I'm pleased to say that the segmented marketing approach and the sales restructure that we initiated has led to a steadily improving result. And we went from negative 21% in the first half of last year to negative 14% in the second half, and a further substantial improvement in the trend so far this year. So we're now in low single-digit decline and expect a return to growth over the rest of the year. It should be said that the problems we had in technology or in IT were only in the UK market. Internationally, IT has continued to grow, and you can see that the perm contract split, top right, is unchanged from last year, and bottom right you can see that this is a much more international business than engineering, thanks to networkers' specialisation in it over many years. I won't go through the technology growth drivers in any detail, as you can read them later, and also I don't have any year-on-year comparisons for this business, since the structure we're showing you here was only initiated in the second half, so we don't have comps yet. With that, I'll move on to the outlook. As we've said in our RNS, we have seen a slowdown in trading in the first 2 months for which we have results. So we're forecasting 3% down for the group for the first quarter, contract down 2%, permanent down 7%. However, more importantly, the strategic repositioning of the group is now complete, with a sharper focus on 2 highly attractive markets a rapidly growing international business which reduces our dependence on the UK economy, and some early success in establishing Gattaca as our recruitment solutions brand with the Unisys win that I mentioned earlier. Last year's problems in our IT business are now behind us, and we now have exceptionally focused sales team who are driving growth in their specialist markets. We are growing our headcount in the international offices in order to capitalise on the growth that we're seeing here, and our business development team have delivered our first pan-European USP in Unisys with an attractive pipeline in place as well. We do face some headwinds in the UK as economic uncertainty takes its toll, and we're carefully monitoring headcount and other costs as we see the sales line developing. But I would stress we do intend to continue to invest in our international business where we continue to see great opportunities. So I think that concludes the presentation, and we're looking forward to taking your questions.
Thank you very much, gentlemen, and there are already quite a lot of questions. I would encourage anybody who wants to type in another one to do so. First of all, from Malcolm, on UK infrastructure, where projects seem to offer you considerable potential under the new government. You mentioned Hinckley and Heathrow. Would it be possible for shareholders to see revenue benefits as soon as the current financial year for projects such as that?
Yeah, I think there will be benefits to come this year. What's not widely appreciated is that Matchtech's engineering business is very heavily weighted towards not only white collar but also to the design phase of large projects. So some of our biggest clients, for example, are consulting engineers. We've actually had people working on HS2 for several years now, and with the decision on Heathrow, I think it's a very good example where there have been some late changes to the plans for the airport in order to comply with budgets and air quality issues. So I think that the decision to build a bridge over the M25 rather than tunnel underneath it, that's smacks to me of a politician's idea rather than something that's been fully worked out. So I wouldn't be at all surprised were we not to benefit from the need to design and plan for that kind of contingency. So yes, although cutting turf on Heathrow or laying the first row of bricks is probably some years away, given where our position in the engineering market, I think we'll be experiencing the benefits of it much earlier than some of the other recruitment firms who focus in on the construction side of these projects.
Good to hear. On the name change, or the brand change, Sadiq is curious if you could give a few more examples of improved clients' perception and engagement on the external side, and indeed if there have been any benefits to internal account management and business targeting.
Yeah, to take the first question first, our clients don't really see the name change. We continue to operate with our client-facing brands of Matchtech and Networkers, so there's been no change there. It's enabled us to remove some of the confusion. Matchtech provided some IT staff, Networkers provided some engineering staff, so having a much clearer brand differentiation between the two is actually very helpful. One of the benefits we've seen, well, there are a number of benefits that have come from this. First of all, our Networkers staff, who we inherited along with the acquisition, no longer feel, in a sense, second best, given that they were previously seen as part of Matchtech, and there was always a lot of confusion about whether that was Matchtech PLC or Matchtech Engineering Recruitment. So that's a substantial benefit from a staff morale and motivation point of view. But more than that, having the Gattaca brand makes it much more plausible when we go out to the market and say, yes, we are a specialist engineering and technology recruiter, but we can also provide a fully integrated recruitment solution tailored to your needs, whether that's recruitment process outsourcing or a managed service program, as we've agreed with Unisys in Europe. And having a brand which isn't associated with one sector of the market, like Gattaca, is very helpful in those circumstances.
All right, thank you. Tony, a question for you on reporting numbers from John and indeed one or two others today. Your headline RNS numbers refer to statutory earnings per share, but early analyst comments and indeed in your presentation just now you've talked about adjusted earnings per share, and there is clearly quite a significant difference if you work that through to price earnings ratios. May that have accounted for some of the share price weakness today? And do you consider showing adjusted numbers more to the forefront in an RNS?
I mean, I've explained what we add back to the earnings per share to get an underlying picture. So like for like, the challenge we have with earnings per share in the prior year is obviously we didn't own Networkers, so it's difficult to get a share number for shares that weren't issued to fund the acquisition. So the analysts do that, and they provide a like-for-like figure. Obviously, the challenge is always when you've made a big acquisition like this, the reported figures tend to show the effect of the acquisition on a full year, which distorts the picture. So I think the effect on the share price is probably the impact of flattish performance between the 2 years, and obviously, you know, we have seen a slight slowdown in activity in the UK. So I think that's more the impact on the share price than the EPS figure.
Thank you. Right, now, quite a long question here. I'll see if I can get it in. Alice is looking back at the acquisition of Networkers, which already looks a shrewd move in terms of gaining overseas exposure. Could you briefly speculate where Matchtech would have been without doing the deal? And then more importantly, looking forward, is your focus now very much on reshaping and maximising the potential of Gattaca and slimming down the debt that you referred to? Or do you think that you still might do further M&A deals to accelerate your growth in non-UK revenues?
Do you want to take the first question, Tom?
Yeah, I think where would we have been? We, as a board, we took a decision to. We knew we had to internationalise the business. To be 98% UK centric, obviously is cyclical. More international we are, the more balanced we get to the business to ride different cycles. I don't think as a single site recruitment business we were successful. We were very, very good at what we did, which is a single site UK recruitment business, and where we had tried to do things differently, they hadn't been greatly successful. So if we had progressed on the internationalisation of the group, I think it would have taken a long time. I think we would have made a few mistakes, and that's really why the Networkers acquisition was attractive to us. It gave us that international capability, 10 international offices in locations we would probably want to be in: Asia, North America, and the Middle East, where we know there's business that we could win, and they were all profitable. So in terms of the acquisition, it was an ideal fit to take that step to grow us, give us the international footprint.
Yeah, and just building on that, if we hadn't have done it, well, we wouldn't have enjoyed the 30% growth from the overseas business that we had last year, nor would we have benefited from the revaluation of the balance sheet at the end of the year. So it was a very good move. Moving on to the second part of the question, our priority now is to get back to growth, and that's probably going to be a bit more difficult in the UK now than it was before the 23rd of June. However, we're very optimistic that we can get good growth out of our overseas businesses, and frankly, if it doesn't come in the UK, accelerates the progress towards getting a business that's 50-50 overseas and UK based. The way that we'll do that is by creating or building scale in the offices we've inherited. So we're not going to spread ourselves too thinly. We're not going to, go for the vanity of lots of pins on the map. We've in 8 of the 11 offices that we acquired, we've already moved out of them and into new offices, which are bigger, which are more modern, which have better communication systems, so that we can actually engage more salespeople to win more business at higher margins in a less competitive market with, generally speaking, higher growth rates. And that's the plan. Just to give you an example, our office in Dallas in the States couldn't accommodate more than 30 people. We've now taken on space which can accommodate 85. We've got a regional managing director who's a Texan, so he's on site. He looks after our business in Mexico as well as Canada and the US. He knows the American market. We've supported him by appointing an in-house internal recruiter and a learning and development manager. So we're developing a business which is scalable. We can hire American nationals, we can attract them to us, we can train them in the Gattaca way of doing things, and we can build a big business in the States, whereas what we had before was essentially relatively small businesses, largely reliant upon expats who were achieving high billings but not doing particularly well outside of those key areas in telco where we had followed our clients in previous years. So our priority is to pay down the debt, and once we've got another year of that under our belts, I think that's the time to consider whether another acquisition makes sense. It may well do, but a good mix of organic and acquisitive growth over the next 5 years or so, I think, would be a good result for us.
Great, thank you. And I think that deals, we had a question from Imran about whether the short-term sector and share price weakness would be a strategic inhibitor to you, which it clearly sounds not. And the second part of his question was, clearly one for you, Brian. You bought quite a lot of shares in Gattaca and not too long ago. You've been quite confident today, and in your statement, are you more confident than a few months ago, or less confident, or similarly confident?
No, with each month that passes, I get more confident in the future of this business. There is a tremendous spirit in Gattaca. The levels of staff engagement are extraordinarily high. We measure that. That's not a bit of fluff. It's not something that I feel. It is a tangible metric that we monitor regularly. So, with motivated people who are well directed, with excellent marketing collateral, and a strategy which everybody gets and is enthusiastic about, I have enormous confidence that the growth potential in this business is unrealised but realisable in the next few years. So that's why I'm backing myself and putting my own money into the company.
Perhaps one for you, Tony. Anton just asked if you could clarify engineering technology. Is that an entirely new service capability and revenue line, or does it reflect any cannibalisation of the two core components?
No, we've been in the skill sets that fit into engineering technology for a number of years. I think what we've now done is defined what market it's going after, looking at the Internet of Things, that link between engineering businesses that are wanting to connect up to the Internet via technology. So it was really bringing the 2 or 3 departments together that were focused on slightly different areas, bringing them together into one team and being able to go to market as the product engineering technology.
Thank you. Right, still time for a couple of more. Question from Matt on the automotive sector, given the uncertainty from Brexit and then the recent Nissan deal, the attention of global auto players on the UK is clearly very topical. For Gattaca, could you explain in a little more detail whether your fortunes are very tied up just in the UK, or whether clients like JLR are already using your skills abroad?
Our auto business is currently mainly UK, but in the last year or so, and in fact through the engineering technology division, we're doing a lot more work in Germany with Volkswagen for one, and in fact we recently won a contract which we announced with BMW, which makes us their master vendor in the UK, where we were previously only one of 8 suppliers. So no, we're actually very positive about our auto business. We were 4% down last year, as I said, but that was mainly down to some margin reductions, which we took on in the short term to win the BMW business, and as the new business comes on at commercial rates, that will reverse out, and we'd expect to be back to growth in 2016-17.
Okay, thank you. Dividend cover, a question from Ashraf. It seems very sensible to him, and indeed ourselves, that you are looking at dividend cover over a cycle for setting your dividend, and he is much encouraged by the increase that you have just declared now. But could you give a perspective looking at, on the other hand, how big a decline would there need to be in UK NFA, how big a deterioration in UK economic conditions for you to rethink the dividend level? Or is it a case that you can move very quickly to cut costs appropriately if income was struggling again?
Yeah, we've always stated we wanted a cover of 2 over the cycle. When we floated, we had a cover of 2.3, and then through the recession 2009-10, dividend cover fell to 1.3. Our profits, whilst they did dip in the recession, were more resilient than the other recruiters, and as a contract-led recruitment business, if the contract business contracts, you actually generate more cash. So I think there is a point where the dividend cover gets to a point where it is probably prudent to cut the dividend, but we didn't reach that in the last recession, so I don't really foresee the need to do that if there is a slowdown. It would have to be quite a major slowdown for that to happen.
Thank you. Last question. Nice easy one for you, Brian. Paul is just asking if you could explain a little bit more about where the name Gattaca came from, which I think I could do, but I'll leave that to you.
Okay, yeah, we whenever you have to select a new name, one of the first difficulties is finding something that somebody else hasn't already registered. So that's one restriction. But we hit upon the word Gattaca, and as I said earlier, we liked it because the word contains the initial letters of the 4 strands of human DNA. And we see this as a business that's all about people. It does feel like a family business, so it just seemed to capture the spirit of an organisation which contains individuals who are all unique and each are pursuing their own specialist market, but nonetheless share a common DNA and are part of a big family or clan unit. So that was why we picked it. Some people hate it, some people love it, but I'm sure that before long it'll not be remarked upon in the future.